powerful financial framework. It's called the 75-15-10 rule. Think of it as your financial GPS for life. Here's how it works. 75% of your after-tax income is for your lifestyle. This is everything: your housing, your car, your groceries, your Netflix subscription, your nights out with friends. Everything you spend to live your life right now fits into this 75%. If your potential mortgage payment is going to push you way over this limit, that's a major red flag. Next up, 15%. This is the non-negotiable part. 15% of your income should go towards investing for the future. We're talking retirement accounts, index funds, building long-term wealth so you can actually retire someday. You can't sacrifice your future self for a house today. That's a trade you'll regret, I promise. And the last 10%, this is for giving, whether it's to your church, a favorite charity, or helping out a family member in need. Cultivating a habit of generosity is not just good for the world. It's good for your soul and keeps your relationship with money healthy. Okay, so you've got the 75-15-10 rule down. What's next? The down payment. I know, you hear all these ads about 3% down, 5% down, but listen up. The goal should be a 20% down payment minimum. Why? Two big reasons. First, it helps you avoid PMI or private mortgage insurance. That's an extra fee you pay every single month just to protect the lender, not you. It's like throwing money away. Second, having 20% equity from day one gives you a massive financial cushion. It prevents you from being house rich but cash poor. That's when your entire net worth is tied up in your walls and you have zero cash for emergencies, opportunities, or, fun. A 20% down payment proves you have the discipline and the cash flow to handle homeownership. And finally, let's talk about the ghosts in the machine, the hidden costs. The price you see on the listing? That's just the cover charge to get into the club. The real party costs more. First, there's moving. Movers, trucks, boxes, new furniture to fill the space. That can easily be thousands of dollars. Then the moment you get the keys, you become the official fix-it person. The water heater will inevitably decide to retire the week you move in. The roof might spring a leak. The AC will go on strike during the hottest day of the year. You need a separate healthy savings account just for home maintenance and repairs. A good rule of thumb is to save 1% of your home's value every year for these costs. So for a $400,000 house, that's $4,000 a year, or about $333 a month, set aside just for when things break. And don't forget the increase in your monthly bills. Property taxes, homeowners insurance, potentially higher utility bills, maybe an HOA fee. All of this needs to fit comfortably inside that 75% lifestyle portion of your budget we talked about earlier. Look, buying a home is an amazing goal, but doing it the right way, on a solid financial foundation, is what makes it a blessing instead of a burden. So run the numbers, be honest with yourself, and make a smart move.